Alright, hello and welcome. My name is Arman Vakili and I would like to welcome you to the first official episode of the Flawless Financial Training Series. I'm the founder of Flawless Financial and I will be your host for the next 52 weeks. Lucky you. Before we actually get started and we actually go into the content of everything, I just wanted to give you a little bit of intro material before we actually dive into all the nitty-gritty stuff, right? So, first and foremost, I want to tell you a little bit about myself and my background so that you understand why I'm actually qualified to speak on this topic. I've been involved in finance for over 11 years now at the time of the publishing of this video, and I've pretty much had the privilege of seeing every single part of the financial sector. So whether it's retail banking, I worked my way up the corporate ladder, learned everything there was about consumer banking, business banking, private banking, and then went into investments and lending, learned about consumer lending, commercial lending, and some of the really big corporate accounts, mutual funds, real estate, stocks, the different kinds of portfolios that are available, debt settlements and how to leverage debt to actually make even more money, insurances, annuities, index stuff. I've literally seen every part of the business. And as I've seen all of these things, I've noticed one common denominator amongst every single company that I've worked for and worked with. 99.9% of every single one of these companies has been designed to make money for the company. It wasn't designed to make money for you or me, the consumer. It was designed to line their own pockets. And it got to the point that my spirit and my purpose in life was clashing and going against everything that was going on with the corporate agenda. So I decided to come out, start my own company, and design this show because of the fact that I believe in being the champion for the consumer. I want to fight for you. And instead of just saying some cliche thing and just saying some promise that most probably people are saying, hey, he's never going to deliver on it, I'll actually give you some information by the end of this video that you can literally take to the bank. No pun intended. Or, well, maybe there is a pun intended. I don't know exactly. But it's really good information and you should totally watch the rest of this video. So the Flawless Financial Training Series that you're actually watching right now has three main intentions. It's going to be super simple, it's going to be super fun, and it's intended to help you. And that's our mission statement. We want your financial success. The schedule of the show is going to be weekly episodes every Monday at 9 a.m. Pacific Standard Time, which would be 6 a.m. Eastern Standard Time. We're gonna do it for the next 52 weeks at least. Hopefully we'll go even longer than that. But at the very least, you can expect to hear from us every single Monday for the next 52 weeks. With the live updates, whatever happens with the market, whether it's the global markets, whether it's the US-based market, really doesn't matter. We're going to create a new episode on it. Most likely, we're going to do a lot of Periscope stuff because it's live recording and live feeds so that you can just get it instantly right away instead of just going through publishing and stuff like that. It won't be as polished as what you're seeing right now, but it'll do the job and it'll actually get you the information. So that's going to be the schedule. And so let's get into the actual content of this specific episode. There is one thing that's probably the most important for you to know, and then we'll actually get into all of the beginner stuff and the general stuff in future episodes. This might be a little bit advanced for some people. I think it'll be pretty good in general because we're going to keep it simple again. But one thing that you need to be always aware of is something called a market correction. Now, right now, depends on who you talk to in finance. Some people will say that we're currently right in the middle of the correction. Some people will say that we haven't seen the worst of the correction. And some people will say, hey, we're never going to experience one, whatever. I personally believe it's better to be safe than sorry. So what you need to understand is that there's going to be a market correction at least every 5 to 7 years in a 10-year period. Between 1998 to 2000 was the tech boom and the dot-com boom, right? And the markets went up and everybody was doing really well and everybody was making money. 2000, Y2K happened and people freak out. They're like, hey, listen, computers are going to take over the world. Pull out all of your money. And it's like, okay, fine. 2001, the planes crashed into the Twin Towers. And so we went to war with Iraq and the markets crashed even further. From 2002 to 2007 was the mortgage and real estate bubble that built up. And in 2007, the bubble burst. And then we had a very, very epic crash, and they were comparing it to the Great Depression and all this crazy stuff, right? And then from 2009, we've had a pretty steady growth. Now, fast forward to today, at the time of this video. It's July 20th, 2015. 2009 to 2015, that's 6 years. We're pretty much right due for a correction if we're not smack dab in the middle of one right now. Which means what? You have to prepare accordingly. And if there is a crash that's going to happen, there is going to be a crash that's going to happen. When the crash happens, you need to be fully prepared to protect all of your assets. And most likely, there are going to be 3 different groups of people that are going to be watching this video. The first group is the banking crowd. They say, hey, listen, I'm just going to go put all my money in the bank. The bank may not give me a really high yield, but it's secure and I'm not going to go negative, which is absolutely true. Who cares if you're not outpacing inflation, right? And who cares if you're paying God knows how much in capital gains taxes? At the very least, you're not going negative as far as your growth is concerned. Then there's the second group of people that says, hey, you know what? I trust my advisor. I trust my broker. These guys have done really well for me. Yeah, there have been bad days, but generally we're pretty good. And I'm just going to trust my advisor and my broker. And you know what? I'm going to tell you one story to this specific group of people. There's a gentleman by the name of Kirk Kerkorian, rest in peace. He passed away maybe about 2 months ago, I want to say approximately. Kirk Kerkorian was the founder of the MGM Grand in Las Vegas, and by the time that he passed away, he had pretty much a stake in 60% of Las Vegas. So a very, very wealthy guy, right? In 2007, prior to the crash, his net worth was something over $16.5 billion, give or take a few million, right? So $16.5 billion was this guy's assets. By 2009, it was less than $4 billion. That's a $12 billion hit, just in case you didn't know, right? $12 billion hit that this guy took. Now, do you think that he didn't have any advisors? Do you think that he didn't have any people that told him, hey, maybe you should make this move or that move or that move? A billionaire of that caliber could still have advisors that still don't know what to do. Nobody can predict what the markets do. I don't care how fancy their license is. I don't care how great of a talker they are. They can't predict what the market does. And it doesn't matter who you are. Doesn't matter how much money you have. You can actually take a hit. There is nobody that can predict the market. I'll say it over and over and over again if I have to. There's nobody that can predict the market. Do you want me to keep saying it? Did you get the point? I think so. Then there's the third group. I'm just gonna manage my own money. You know, I'm gonna go listen to the bank guy, I'll go listen to the broker guy, I'll go listen to this guy that's talking on screen right now, and then I'm gonna go ahead and actually make my own decisions, which is totally fine. Everything else that I'm about to share with you right now is going to apply to all 3 groups. So, let's get into the real stuff. Okay, so if my graphics guy did his job, you should be seeing a slide on your screen right now that's going to show you the 3 different ways that money can grow. So it doesn't matter whether you have a bank account, whether you have a stock portfolio, whether you have a 401k, IRA, 403b, index account, it doesn't really matter. Real estate, precious metals, does not matter where your money is sitting. There's 3 different ways that your money can grow. Now, the first line that you're going to see, the first growth strategy that you're going to see is fixed. Meaning what? That no matter what happens with the market could be booming, the market could be tanking. You're going to get a fixed rate of return. And in this specific example, we're going to go from 1998 to 2013. Everybody starts with $100,000. And if you're getting a 3.5% fixed rate on your money, your $100,000 at the end of those 15 years is going to be approximately $155,000. Now, this is not considering capital gains tax that everybody has to pay. So after capital gains tax, obviously you're not going to even walk away with 155. It'll probably be something a little bit less, right? But that's the fixed strategy, and that's where the majority of people are. They're in their bank account somewhere. Banks are not paying anything close to 3.5% right now, but let's say it's something about that, right? So The next person is in the variable market. So this could be the stock market, this could be real estate, this could be precious metals, it could be anything that can actually go negative. Now in this specific example, we're looking at the S&P 500, which is the Standard & Poor's 500 biggest companies, right? 500 of the most profitable companies that they chose. These are companies like Coca-Cola and Pepsi in the same portfolio, Verizon and AT&T in the same portfolio, Apple and IBM and Microsoft in the same portfolio, right? Really, really powerful companies. Now, 1998 to 2000, as we already discussed, was the tech boom, right? And the dot-com boom. Everybody and their mother was buying domain names, and phones turned from these really big, ugly things to really cute little sleek looking things. And so the market shot up, and it went up really well. And then in 2000, the crash began. 2001, the crash continued. And 2002 to 2007, the market went up again. And in 2007, the bubble burst and the crash happened again. And from 2009 to 2013, we've been having pretty good rates, right? We've been having pretty good returns. And if your money was in the glorious S&P 500, this same $100,000 would be technically something about $160,000, which isn't bad. It's more than what the bank was paying you. But again, you still have to pay capital gains tax on it and all that great stuff, right? So you're not even walking away with the full 160. And then you have the top 1% or the top 2% of the population that says, hey, listen, I want the best of both worlds. I want the guarantee that the bank is offering, but I want to participate in the market because the banks are paying only 1% or 1.5%. And the market goes up really well sometimes. So I want to have the best of both worlds. And so when you look at this screen right now, when the market actually goes up, the index actually goes up as well. So the line that you're seeing that's continuing to go up, that's called an index. So the index will go up as well. But then you see there's a difference right there in 2000, how the market is actually peaking higher than the index does. The difference between those two performances is kept by whatever company actually offers this account to you. So whether it's Nationwide, whether it's Fidelity, whether it's National Westerns, Allianz, doesn't really matter which company it is. It's called a participation fee. It's called the participation rate, right? So they keep the difference because they're using your money to make money. But because of the fact that they're using your money to make money, they're also taking the investment risk. So when the crash happens, you would flatline and you would never go negative. For the most part, 99% of companies don't actually pay you an interest rate when a crash happens, so you'll just be at 0%. So you won't be making anything, but you won't be losing anything. But then there are some companies that actually pay you a pretty decent interest rate even when the crash is happening, but then we'll talk about that in future episodes. So instead of picking up all the way from the bottom of the performance of the market, you pick up exactly where you left off, right? And then it goes up, and again, it's not as aggressive, but when the crash happens, like it did in 2007, you flatline again. And then you pick up exactly where you left off instead of picking up all the way from the bottom in 2009. And in the same exact period of time, starting with the same exact amount of money, your $100,000 turns into almost $200,000. That's pretty awesome. So you can be literally anywhere right now. You can be in banks, you could be in a 401k, you could have a stock portfolio, you could have a real estate piece of property that really isn't doing that well. Wherever you are, you can make the switch into an indexed account. Now, I need to give you a full disclosure. You have to consult with your specific advisor before you make any moves, okay? The stuff that I just shared with you right now doesn't apply to everybody across the board. Your situation is very unique, and everything that is involving money is case by case. So if you would like, you are more than welcome to speak with one of our licensed representatives. They are very, very competent, they're very capable, and they're super awesome to talk to. And they can tell you whether or not it would make sense for you to make the switch from any of the categories that you just saw right now. If you can't make a switch, or if you shouldn't make a switch, we'll definitely let you know. We're not in it to try to coerce you to actually make money from you. Again, remember, the purpose of everything that we're doing is to make sure that you succeed financially. However, there's a 90% chance, 95% chance that you could actually benefit from something like the index. So we won't really know unless we actually look at your specific situation. So go ahead and just let us know. You're more than welcome to click, I believe there should be a link in the description box of this video. If you're watching this on YouTube, there's going to be a link in the description box. If you're watching this on our website, there's going to be a form at the bottom of this video that you can go ahead and enter your basic contact information, and one of our licensed representatives will contact you to talk to you about everything that you have right now to see if it makes sense, right? So I really hope you found this episode useful. I hope you found the information actually valuable. And I hope that you subscribe. I hope you share. I hope you leave comments and questions, because everything that we do is for you. All of the content that we're creating is for you. And so I would much rather create content that you actually want to learn about instead of the stuff that I think you want to learn about, or theories or stuff like that. I would much rather create content that actually applies to your life. You can just go ahead and subscribe to our channel. You can leave a comment. You can like the video. You can share the video. Everything, anything that you want to do, you're more than welcome to do. Or you can just close the page and just go do whatever you were going to do, which is totally fine too. But in either case, I really hope you enjoyed the video, and I look forward to seeing you next week. So you have a great day wherever you are, and I'll talk to you soon.